Get Rich Education is brought to you by Norada Real Estate and Ridge Lending Group.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 73. I'm your host, Keith Weinhold. We're here in tax season, and today we're talking with Rich Dad advisor Tom Wheelwright about building your wealth by making you more tax efficient. We're going from that angle today, okay? And especially as it pertains to real estate investors. In investing and in life, to have something different, you have to do something different. If your chief investment vehicle is a 401k, you're almost certainly not going to live an extraordinarily financial life because your choices will be limited, okay? But 401ks are the norm. And this is something so simple to say, but to have something different, you need to do something different. Real estate investors are different. To have something that others don't, you have to do something that others won't. All right, when you realize that as a successful real estate investor, you profit 5 ways financially at the same time, it can actually take some experience until you realize all the ways that you're getting paid. Now, again, those 5 ways are number 1, you're paid with appreciation potentially, okay? And that is amplified with leverage. Number 2, you're paid by cash flow from the tenant rent payments. Number 3, you benefit financially from loan principal paydown, also known as loan amortization, each month, which is actually a benefit that you don't get in your primary residence. Because in your primary residence, the loan paydown portion, that principal paydown, that came from your pocket. In cash flowing rental property, even the principal paydown portion came from your tenant's pocket. Number 4 is tax advantages, and that's what we're talking about today. And there are so many ways that this 4th way of benefiting financially from real estate effectively pays you, okay? I mean, you've got the mortgage interest deduction, which is a benefit that you do generally get with your primary residence. There are so many other tax advantages specific to income property investors, like an annual depreciation allowance that you receive, even while the property is appreciating. Then you're also eligible to pay 0 capital gains tax and more. That's all rolled up in the 4th way that you benefit financially as a real estate investor. And then the 5th way that you get paid is through an inflation hedging, or really even an inflation profiting benefit, which I've discussed so often as inflation erodes the weight of your debt burden that the tenant actually pays down for you at the same time anyway. Today's guest, Tom Wheelwright, is my wife and I's personal tax advisor, and he's also the first guest to ever appear 3 times on Get Rich Education because he brings so much value every time. Tom is a rare talent because he actually makes taxes understandable and fun, and it's really special to listen to Tom. I've got to laugh because there's one point in today's interview where Tom is just running out with the football. He is running out in the open field for so long, providing you with value on taxes, that I just let him run out in that open field and there aren't any tacklers around. So you're really going to be feeling Tom's energy and enthusiasm as he sprints past the defensive secondary, to use an NFL analogy here. He's going to discuss what some of the new tax law changes are that affect real estate investors. He's going to tell us whether or not he thinks the 1031 exchange is going to go away. He's going to let you know about the presidential candidates and how their tax proposals affect you. And we're going to get a little review on what you need to do to be a qualified real estate professional and how that designation helps you. We'll be right back with that on Get Rich Education. Cash flow real estate investors, this is Get Rich Education's Keith Weinhold. Did you know that you can finance up to 35 income properties all with one lender? Ridge Lending Group specializes in investment property loans, and they do it in almost every U.S. state. Ridge has worked with tens of thousands of real estate investors and homeowners all over the country. They've been doing this for investors for so long that at this point, they've helped more families realize their dreams of becoming real estate investors than any other mortgage lender in the country. To find out more, visit ridgelendinggroup.com.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
This is Rich Dad Advisor Garrett Sutton. To grow your wealth, listen to the always valuable Get Rich Education.
Today's guest is the author of the popular book, Tax-Free Wealth. He's a CPA, and he's the CEO of Provision Wealth, based in Tempe, Arizona. He's a leading tax and wealth expert, speaker, and he's a Rich Dad advisor and speaker for Robert Kiyosaki, the author of Rich Dad, Poor Dad. He's best known for making taxes actually fun, easy, and understandable, and he specializes in helping entrepreneurs and investors build wealth through practical and strategic ways that permanently reduce your taxes. Just last month, he was featured in Forbes magazine. You might already know him as the best-known tax advisor in the world, perhaps, or perhaps just simply the best. Additionally, he owns the tax accounting firm that my wife and I have used for years because he knows how to get all the best deductions for real asset investments like real estate and oil. Our guest has also appeared here on episodes 19 and 62. Welcome back to Get Rich Education, Tom Wheelwright.
Hey, thanks, Keith. It's great to be with you. Always, always, always good to be on your show.
Yeah, it's always a pleasure. Well, we are squarely in tax season now, and taxes are such a dynamic and changing field. So, what are really some of the things to look for in this particular filing season?
We've had some really big changes in the tax law. In December, we had a major tax bill. We have not had that big of a tax bill really for quite some time. So certain things were made permanent. For example, the Section 179 deduction, which every real estate investor should know about because that's an opportunity to actually deduct a lot of, like when you go and redo a house and you put in, new cabinets and you put some, new fans and so forth like that. A lot of that is available as a deduction under Section 179. That was made permanent under this new law. Another thing that came about last year really were these new repair regulations. So, when you're doing real estate and you're refurbishing a house or a property, and you really have to look at, okay, what of this is really improving the property that's going to be, we have to capitalize, we have to deduct over a period of time, what we call depreciation, or what can we actually just deduct as repair? And it's amazing, Keith, how much we can actually deduct. And there are tricks. There are things we can do. I'll give you a really simple example.
Okay.
Let's say that you own a building and your business is leasing part of that building. Okay, so you're leasing out the rest to other people, but you're leasing part of that building. If the business does the improvements, the leasehold improvements, they're probably going to have to be capitalized, depreciated over 15 years. But guess what? If the building, actually the company that owns the building, does the improvements, in other words, landlord does the improvements, most of those are going to be deductible in the year that they're incurred because they're not going to change. It's just what's the proportion that they're changing. For the tenant, it's 100% of their space. For the building owner, it may be only, for the landlord, it may only be 10% of the space. And because of that difference, just that little change, it can be the difference between, do I deduct it over 15 years or do I get to deduct it currently? So that's done. So speaking of tax preparation, that's done during the tax preparation process. So, one of the things you ought to be asking your advisor is, I've got all these things that I've done, all this money I've spent. How do we do this in such a way that we're going to be able to deduct it now instead of deduct it over the next 15 years or in some cases as long as 39 years?
Okay, so this Section 179 deduction is the first I became familiar with it. That's pretty significant, and that's actually a good thing for real estate investors if we can write off that entire upgrade in that tax year.
Right. So we have two things here that we're talking about. The 179 deduction, which is actual equipment. And here's the thing that I hear advisors all the time, tax preparers say, well, it's a rental, so it's not deductible. No, there are rules that apply to rentals that are different than like an ordinary business. That doesn't mean it's not deductible. It doesn't mean it doesn't qualify for 179. It just means you have to pay attention to the rules. And that's where your tax preparer and your tax advisor come into play. The other one is what we'd call a Section 263 deduction, which is a repair deduction. And the question is it a repair or do I have to capitalize it? Now, here's an interesting thing. Even if I capitalize it, I may still be able to deduct it under Section 179. So these rules play together. Well, this is what I love. This is why I love the tax law, why I think it's fun, is because all these rules play together. And it means that just if we understand how the tax really works for us, then what we can do is we can go, oh, well, geez, I can do, if I do this, 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 and this, now I get a tax benefit that if I didn't do those things, I have the same expenditure. I have the same cost, but now if I can get the government to pay 40% by giving me a tax deduction, I've just saved a ton of money.
Yeah, that's significant. Okay, so we're talking about repairs and upgrades here, maybe during the duration in which an investor owns a property. What about some of those considerations when it comes into filing season when someone is about to acquire a property or knows that they're about to sell a property? What are some of those planning things that they can do leading up to that?
Let's talk about the about to acquire property. So one of the things we always ought to talk about is a cost segregation. Cost segregation, simply you're hiring a professional. We've talked about this before, Keith. When you hire a professional to go in and break down what it is you're buying in that property. So for example, one of the things I'd want when a client buys a property is I'd like to see if I'm buying it from the person who built it, do they have the blueprints? Do they have the original construction diagrams and the information on the original construction cost? Because I'll tell you what, that'll save you a ton of money on that cost segregation, and not just in the tax savings, but it'll actually save you a lot in the fees you paid to the cost segregation expert to do it. So I'd be looking at that. Second of all, on the flip side, on the sales side, you always have to look at what are you going to do with the money? When you sell that property, what are you going to do with the money? Because if you're going to buy another piece of real estate, this is one of your favorite topics, Keith, you want to really do that like-kind exchange. And so when you do that contract, how you, even in your initial sales contract, you want to put it in language that allows you to do that like-kind exchange. It doesn't affect the buyer at all. It doesn't have any effect on them, but we have to put the language in there so that you're able to have your qualified intermediary. And we go through all this in my book, Tax Free Wealth, so you can kind of go back to getting the details. But you want to be able to allow your qualified intermediary to essentially handle that transaction for you. And if you don't set up your contract right, then you're going to have a problem with that. But that's something that can be done and it can be changed. You know, if you're in the middle of a contract, you can change that contract pretty easily. It does not affect the buyer. It only affects you, the seller, to do that like-kind exchange.
Yeah, these things really take some planning and some communication with your team, investors. So, well, you mentioned the 1031 exchange, and it seems like, gosh, it almost seems anymore, Tom, like this happens every couple years. I hear it come up. Some people are concerned that the 1031 tax deferred exchange, and sometimes really even the mortgage interest deduction too, that's potentially on the chopping block, that those things might go away as the government tries to raise more revenue, that they're not going to incentivize real estate investors as much. How do you see it in today's climate? Do you see any significant threat to the 1031 tax deferred exchange or the mortgage interest deduction just going away?
Going away completely, not a lot. I'll tell you what, it's interesting to watch the political process in the U.S. right now. Just fascinating. Fascinating to hear. On one hand, you got Ted Cruz, who wants to eliminate the IRS. Okay, good luck with that. On the other hand, you got Bernie Sanders, who wants to 90% tax rate. Good luck with that. Where you're going to end up, of course, is somewhere in between. Now, people tend to dismiss the Bernie Sanders because he's so far in one direction, or Ted Cruz because he's so far in the other direction. What we have to recognize, though, is that there are pieces of what Bernie Sanders talks about that are coming up all the time. I mean, for example, he's suggesting a limit on the tax deduction for itemized deductions, the benefit of itemized deductions of 28%. So in other words, if you're in a 48% bracket, you only get a tax benefit of 28%. Well, we go, wow, boy, that's a real reduction. And boy, we've got this liberal Democrat. Do you know who first proposed that? Was Mitt Romney. That's not a Democratic proposal. That was a Romney proposal. And I'm going, look, if you got a Republican proposing it and a Democrat proposing it, guess what's likely to happen? It's going to happen. That's an easy revenue raiser. I'll tell you another one we ought to be paying attention to.
Okay.
And that is the cap on Social Security. Remember, Social Security tax is on earned income. So if you're doing flipping or developing, anything like that, that's earned income. The cap right now is about $118,000. After that, you only pay the Medicare portion. You don't pay the Social Security portion. So the 12.4%, you don't have to pay that after $118,000. Bernie Sanders is talking about eliminating the cap on Social Security. I will tell you, I honestly don't understand why that has not been proposed before, why we don't hear about that all the time. If I were a politician and I was looking for a way to raise revenue and I was only going to hit the high income taxpayers, that is the first place I would go. Now, the reason it hasn't gone that way from a policy standpoint, of course, is that some people, not very many of us anymore, still have this idea that Social Security, what you pay in is what you should get out. Nobody's going to get out anything beyond that maximum pay-in of $118,000. You're not going to get that out. I think most people understand, Keith, that Social Security is just another tax. It's not a pay into the system and get out of the system anymore. That notion, people should just forget about that. It's just an additional tax. So when you see that kind of a proposal, you should go, oh, I better pay attention to this because I think that proposal is going to get legs at some point. One other proposal, and this affects real estate a lot.
Okay.
And that is the carried interest rule. Now, this is kind of a difficult concept to get. I'm going to simplify it so it's going to be really understandable here, right? Fun, easy, and understandable. So we're going to make it understandable. So here's what happens. Just think about the difference between ordinary income and capital gains. If you've ever invested in stocks or you've ever bought a piece of property, you know that if I hold it for more than a year, it's subject to long-term capital gains rates, which is about half of my income rate, my ordinary income rates. If I sell it within that first year, it's going to be subject to ordinary income rates. General rule. So what we want to do is we call that conversion. We want to convert our property, our income, from a high taxed income, ordinary income, to a lower taxed income, capital gain.
Right.
So one of the ways, of course, that you're going to tell your investors how to do that is, well, rent the property out, right? Rent the property out for a year, hold it for a longer period of time. Well, here's what real estate developers do. They go a step further. So you've had Ken McElroy on your show, and I am confident, I'm not his CPA, I'm confident he does this. In fact, I happen to know he does it because I've seen his deals. And that is, what they do is they say, well, we're not going to take a bunch of fees up front. Instead, should the property increase in value and eventually we sell that property, we're going to get a portion of that sale. Well, when we sell the property, what kind of income is that? Well, down the road, we sell that property. That's capital gain.
Sure.
So if I defer my income, so if I take fees, so if Kenny were to take fees, he'd have ordinary income. But if instead he takes a share of the capital gain, that's called a carried interest. He's carried that interest. He gets capital gains rates. So that's a good way. When you have investors, oh my heavens, we just did another developer that is a client of ours. We just changed their agreement where we converted all of their ordinary income. They were taking all sorts of ordinary income. They're just brand new client, taking all this ordinary income and picking up as fees. We're going, you know what? I think all we have to do is make one little change to your agreement and we can make that all capital gains. And we did. So what we did is we actually converted $1.5 million of income from ordinary income to capital gain. We're in filing season, right? Here's the deal. We can change our partnership agreement up until the date we file the return. So in other words, for 2015, I can go back to January 1st of 2015 and change my operating agreement or my partnership agreement, and up until the date when I file my partnership return. So if I file my partnership return April 15th, I've got the next 2 months to change that agreement. I can go and change that agreement retroactively. It is entirely legal. Now I can go back and change that agreement retroactively as of 1/1/15, and I could change that nature of that income from ordinary income to capital gain. So that's called the carried interest. Now, what Bernie Sanders has proposed, Hillary Clinton has proposed it, Barack Obama has proposed it. It has been proposed. In fact, it's actually been in several bills over the last few years, is to eliminate the ability to get that carried and to change that to capital gains. Okay, so if you're going to take advantage of that, here's the other thing to remember about tax law, and that is that there's almost always a grandfather clause. And a grandfather clause just says that if you put it in place before the date that we announce the change, we're going to allow it. So we're not going to change things retroactively. That's bad tax policy. That is something that did happen. By the way, we do get those retroactive changes from time to time. When the passive loss rules came in, and all real estate investors are intimately familiar with the passive loss rules, when that came into account in 1986, I was back in Washington, D.C. at the time. When that happened, that did go retroactively. That was really bad tax policy, but that went retroactively. That's pretty rare. So this carried interest rule, what I would suggest is make sure that you're working with your tax advisor right now. Let's get that changed, not just so that you get the benefit for 2015, which you can, but also so that in case they do change the law, which I think that one is likely to go, I really think that one will pass eventually. It's just a really easy revenue raising. And the reason it'll pass, by the way, is because Wall Street has used it and they've misappropriated that rule for themselves. That rule was always intended to be for real estate investors, and Wall Street figured out how to use it for an IPO or a venture capitalist. And because of that, I think it's going to go away. And I don't think the real estate lobby can prevent it. I think that's one that's really on the chopping block. I'm less concerned about like-kind exchanges. Could they happen? I mean, under a Bernie Sanders, I wouldn't be surprised, but nobody thinks Bernie Sanders is really going to get elected. Could it happen under a Hillary Clinton? Could it even happen under a Jeb Bush? Absolutely. I mean, those things could happen. It's not going to happen under Donald Trump. Okay, so Donald Trump's your candidate, and you think he's going to win. You don't have to worry about some of these tax provisions. I don't think you have to worry about, as we're talking about the elections, I don't think you're going to have to worry about a flat tax. I think that is unrealistic, nor do I think you're going to have to worry about a 90% tax. So, when you go to the extremes, I'm not too concerned about that because that's why we have Congress and the Senate. They have to pass this too. It's not just what the president wants, right? I mean, President Obama has used a lot of executive order, even in the tax area. I mean, he's created tax law using executive order. Certainly the Republicans, if a Republican were elected, I don't think you'll see a lot of executive order just because that's their campaign promise. And I just think they'd have a tough time. They'd be a one-term president if they used the executive order like Obama has. On the other hand, Hillary her presidency is based on let's continue what Obama's doing. So I would expect her to use executive order a lot. All right. So you kind of have to look at that piece. But the extremes, Hillary's not extreme when it comes to taxes. Okay. She's not. She's pretty much a middle of the road tax person. Don't get me wrong. She'll probably raise taxes, but she's not going to be the extreme that a Bernie Sanders would be. So you kind of look at those proposals. See, even in Bernie Sanders, though, those three proposals that I talked about, carried interest, itemized deductions being limited to 28%, the cap on Social Security, those are not extreme proposals in my mind, okay? So those are things that could they pass? Yeah, I'd be watching those. A wholesale, like eliminating the tax benefit for oil and gas, eliminating the tax benefit for real estate, the like-kind exchanges. There's all this talk about lobbyists and how they're evil. I'm sorry, but I think that's part of our check and balance system is that you got a lot of lobbyists and they have opposing interests. So as long as they require a balanced, I would like to see a balanced budget. But if they require that any tax benefit comes with a corresponding tax increase that offsets, which they didn't do this year, which was the biggest issue, by the way, in that 2015 December tax change, is that they didn't pay for it. They put no provisions in to pay for these changes. The changes, for the most part, they were really good changes. They made the research and development tax credit permanent. That is a really good change in the law. The 179 deduction, they made it permanent. That's a really good change in the law. The conservation easement deduction, by the way, that's a huge one. They made that permanent in the law. So they did that, but they didn't pay for it. So one of the concerns we have to look for is, okay, how are you going to pay for this stuff? I would look at all of this and you're going, okay, I know everybody's heads are spinning a little bit. Simplify it down. Just break it down, okay? If you see something over and over again, that's when you start thinking this may pass. If you see something to the extreme, don't worry too much about it.
There's an awful lot to touch on there. I mean, flat tax, I think some parts of society are really behind that due to its simplification, but We know as real estate investors, we begin to lose our incentive. If we have a flat
Right.
tax, you start to lose that behavior that the government does to incentivize people to do certain things in society, like provide food, energy, or as a lot of us do, provide housing. So flat tax isn't so good for us and our listeners. Just dropping back to the carried interest, why don't we just discuss a little bit? I mean, we don't want to go over the entire marginal tax rate tables and such, but just discuss a little bit how much more ordinary income taxes are versus capital gains taxes today.
Well, it's about double. You got to think that the ordinary income rate, the top rate federally is 39.6%. The top capital gains rate, depending on how you do it, is either 20% or 24%. So here's a key. By the way, you real estate professionals, this real estate professional status does not just affect whether you can take those losses. It also affects whether you're subject to the 3.9% tax on your capital gains. This is really important. That's an extra 4% on your capital gains. If you're a real estate professional, you are not subject to that extra 3.9% tax. If you're not a real estate professional, you are.
Okay, so that 3.9% is pretty significant. I mean, if you can go ahead and not pay that extra 3.9%, that's just like an instant rate of return to you. I like to think of it that way.
Totally. I mean, any tax we don't pay, it's a tax-free rate of return. Because remember, we don't get a deduction for taxes, right, that we pay. Any tax savings we get, that money goes straight into our pocket. That's why I always say that fastest way to put money in your pocket is to reduce your taxes.
That's right. And, we ought to hit on this real quick, Tom. I think most of my listeners have heard of what it takes to be a real estate professional and some of the incentives that provides you. If you can distinguish yourself as a real estate professional, why don't we touch on that a little bit? Just what does it take today for one of my listener investors to be designated as a real estate professional as defined by the IRS, and what are the benefits?
It is very simple. First of all, it's just think of it as your get out of jail free card. Okay. It means that all the losses that you should get from your depreciation, okay, you take your 179 or you get your repairs, all that kind of stuff. All of those losses are fully deductible against other income. They're deductible against your salary from another job. They're deductible against your completely unrelated business. Okay. They become fully deductible. Ordinary losses are the best kind of losses. And that's what happens when you're a real estate professional. The rules are really simple.
Okay.
Number one, you must spend more than 750 hours a year in real estate, period. Okay, just more than 750 hours, all right, in real estate. And it needs to be not just investment hours, okay, but you actually have to be, either looking for the property, helping to finance the property, helping to manage the property, developing the property, et cetera. Okay, so you can have investment hours, but not just investment hours. So over 750 hours, that's rule number one. Number two is you have to spend more time doing your real estate than you do all your other jobs combined. So there was a case years and years ago. A nurse worked at her job 2,200 hours, actually proved that she spent more than 2,200 hours in real estate. I mean, this was a busy woman.
Yeah.
She still lost. And the reason is that you have to still meet the other passive loss rules. Okay. So once you're a real estate professional, you still have to meet the other passive loss rules. So the other passive loss rules say you have to work more than 500 hours in an activity to get those ordinary losses. What's an activity? An activity is a single piece of real estate. So if you have 100 properties, you're not going to work 500 hours on every single property. So here's what you do. There is an election. It's called, everybody should write this down. It's called a 469C7 election. 469C7.
Okay.
That election allows you to treat all of your properties as a single activity. Once you do that, now you're going to meet that 500 hours because you already met the 750 hours, right? If you meet the 750 hours, you're going to meet the 500 hours. But you must make that election. This woman, bless her heart, she spent 2,400 hours on real estate, did not make the election, lost the case.
That's awful. And that's like 6 or 7 hours a day on average all year.
Right. So she put in the time. In our minds, we go, she was a real estate professional. Of course she was. Yep, she was. But not under the rules because she did not make this election. So make sure that it's a real simple election. For me, when we do a tax return, it's a box we check. But I've seen that box missed probably 50% of the time. I see that box missed. Not, of course, not in our firm, but people who don't know real estate. So I would suggest also, by the way, if you're a serious real estate investor, if you're going to think you're going to meet those real estate professional status, make sure that your tax preparer is a real estate professional from a tax preparation standpoint. I mean, real estate is one of the most complex areas of tax law. I would tell you what, here's a funny one for you. So Ken McElroy, his partner's CPA is who does their work. But when Ken has a tax issue, he calls me. It cracks me up because what Ken knows is that I've spent 35 years doing real estate taxes. Okay, so I'm going to come up with a solution that his tax preparer doesn't do. So even though he lets his partner be happy and have his partner CPA, do their work on a routine basis, when he's got an issue, he always calls me. So you just make sure that you've got the right professional as you grow your real estate portfolio.
Yeah, and Provision has helped me out quite a bit with that, your firm. I didn't, actually make that 469C7 declaration, but, there's similar things that you have seen coming that your firm goes ahead and emails me and asks me to make this and that declaration so that you can prepare my taxes in a certain way. And, I guess what I'm getting at here is like a key word to a proactive tax firm like yours is anticipation. You know what to anticipate in order to save me the most on my taxes for the following years.
Yeah, it's just a mindset. I always say it's how do you look at it? You can look at the law as, boy, this is this evil thing that's out to get us. You can take, to me, that's the Ted Cruz approach, right? Or you can look at the law as, wow, this is an opportunity. You've used these words a lot just in the short time we've been on together, Keith. I've heard you use, well, what are the incentives? What are the benefits? Well, the tax law is just a series of incentives for business owners and investors. That's all it is, fundamentally. It's a mechanism that the government uses to drive tax policy, and does in every country. It's the same, to not drive tax policy, but actually drive all policy. So it drives social policy, it drives economic policy, it drives international policy, it drives energy policy. It drives every single policy we have. It's no different than you have employees. Think about this. If you have an employee and you want them to behave a certain way, what do? You give them a bonus for acting that way.
Sure.
That's how you incentivize them. Well, guess what? The tax law does exactly the same thing. So you just have to pay attention to that. You don't always have to make that C7 election. In fact, I don't. It's bad for me. For those people who just, what they're really doing is they're buying single family homes. That's when it really, comes into play. So sit down with your tax advisor. Don't make the mistake of saying, well, I don't understand it, so I don't want to deal with it. The tax law does not have to be scary to you. I find it to be really a well-written document. For the most part, I mean, there are a couple of places that I'm just going, really? You're really telling me to do that? But for the most part, it's a well-written document by very smart people. They've spent a lot of time looking at it, and it just takes you sitting down with your advisor as a team together. You've got to understand the concepts. Your advisor has to understand the details. And that's what I look at. I look at content versus context, and I go, okay, content has an N for nitty gritty, right? That's what that N stands for, is nitty gritty. That's what your advisor's for. Okay. And context has an X for extraordinary. That's the extraordinary step. You've got to understand that really the fundamentals, and when you really get that context and you understand that the tax law is a series of incentives, now you've got a whole different approach to the tax law, and you go, wow, how can I use this to my benefit? Not, is this deductible? That should never be the question. The question should be, how do I make this deductible?
Yeah, it's more about asking the right questions. So,
yep.
Yeah, I mean, once one realizes that the tax law really is a series of incentives and you're doing that behavior that the government wants you to do with real estate, what used to be fear, I think, turns into anticipation. I mean, shoot, Tom, I think you even anticipate audits. You don't want to see any of your clients get audited, but you love it. You look forward to it, more than the IRS.
I was doing a training for our staff just yesterday, and I said, look, one of the things we tell our clients is we prepare every return as if it's going to be audited. Now, very few of our tax returns are ever audited, but we prepare them as if, because you know what? If it's audited, it's going to be audited 2 or 3 years from now. Well, guess what? You're not going to remember a thing about, 2 or 3 years from now. And if your preparer has not made sure all that documentation is in place, they're not going to remember it either. And then you're going to be in a mess, and you should be afraid of that audit because it's going to be a mess. But if your preparer is preparing for an audit in the first place, I mean, we even, for a lot of our clients, we actually offer them what we call an audit defense plan, and where they pay, a fixed fee every year, and then we handle the audit for free. We only do that with our clients that they go, okay, I get it. I get that you're spending the time, so my fees are going to be a little higher than some other preparer, but I get that you're going to spend the time to make sure this is right, because, and then we're going to go, well, if you do that, then guess what? We're willing to take on the potential cost of that audit because we're not afraid of it because we put the time in.
I sure have been pleased since I've used Provision Wealth as my tax preparation firm. My fear sure has gone into anticipation. Tom, how can my audience find out more and to see if a consultation with Provision might benefit them so you can find out what their situation is?
Just go to provisionwealth.com, Provision wealth.com. And there's top right-hand corner, a place for a free consultation. Or you can call us at 866-467-5809, 866-467-5809. Just ask for our client service group. They'll be happy to set you up.
Okay, it's been valuable as always, Tom. Thanks again for coming back on to Get Rich Education, providing so much value to the audience.
Always happy to be here, Keith. Thanks so much.
Well, some great tax takeaways there. Tom brings the energy as always. Tax policy is just ever changing, and it's great to have a progressive firm like Provision that's always on top of the changes to maximize the benefits of real estate investors like us. If you would like to hear your own voice here on Get Rich Education, what you can do is that the next time you're at getricheducation.com, click that send voicemail button over on the right of the page and leave your question or your comment there. That is the SpeakPipe app. I've realized that the SpeakPipe app has rarely been used lately because I haven't given a reminder about it in such a long time, okay? It's a great way to send us a question or a comment so that we might have some two-way communication here and we might use your message on the air. So again, that's at getricheducation.com. Over on the right, just click that little send voicemail button and it's very easy to click through and just leave your message that way. Until next week, I'm your host, Keith Weinhold. Don't live below your means when you could just as well expand your means, and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.